Capitalist Show. He is one of my favorites. When I started in this macro journey back in 2012, he was someone that I always wanted to interview. It was really Jim Rogers, Rick Rule, and Doug Casey. This is a dream come true for me. So Rick Rule, welcome back to the Rebel Capitalist Show, my friend.
Well, thank you. With that lineup, you had to act quickly before we died. We're the sort of old horsemen in the business.
Well, you need no introduction. Everyone knows exactly who you are. So instead of going into a backstory, let's go right into the questions. And one question I get all the time on my channel is if you can't buy physical gold right now, and I'm in that situation. I've been traveling all over trying to find the most freedom in the world, which is hard to do right now. So I can't take delivery of physical. It's just not convenient for me. And I've been referring people to Sprott's product, the PHYS. So can you tell us about that product? How does it work? Who's the custodian? How does it compare to GLD? And then how does it compare to physical?
Well, thank you. That was a softball question. If I'm in your your neck of the woods, I'll buy you a bottle of wine for that question.
Well, I owe you for the chocolates you sent me and my sister. I mean, that was one of the kindest things you've ever done. In fact, when we got done with that interview, Callie, your assistant, I think she emailed me and says, "Well, we want your address." I'm like, oh no, what did I do? I must have done something wrong. But anyway, I really appreciate that. And when people ask me about PHYS, the one thing I always say, I said, listen, I'll get Rick on to talk about it. But the one thing I know is Rick is a great guy, that's for sure. And I always tell them that story of the chocolates. So anyway, go ahead and tell us about the product.
That's kind of you, understanding that this can't constitute investment advice because I don't know the person that's asking. In a very broad sense, let me begin by saying that I'm a fairly large owner of that product. At Sprott, we eat our own cooking, both because it's the right thing to do and also because it tastes good, frankly. And under the product, the Sprott Physical Precious Metals Trusts, we have 4, physical gold, physical silver, physical gold and silver, and physical platinum and palladium, are trusts that trade on the New York Stock Exchange. They trade like water. They're really liquid. They have low or no premiums, depending on what sort of commission your people pay for their securities accounts. You know, if they're at Robinhood, as an example, they can buy them for free, not the sort of premium that you see in the physical products. But they are all backed by physical, and the physical itself is held at the Royal Canadian Mint. And in fact, if you buy large enough quantities, 400 ounces as an example with gold, they're redeemable, meaning that you can surrender your certificates and get physical possession in system, LME or CME grade in system. For American shareholders, they may offer tax advantages in that with gold or the ETFs like GLD, you are taxed at the collectibles rate. With the trust, you're taxed at the capital gains rate. So as an example, a California or New York taxpayer would find a substantial tax advantage if he or she generated a capital gain from their holding. Importantly, if you buy gold like Sprott does, in-system gold from the banks, there are not the physical shortages that are happening in the retail space. Many people who are buying retail quantities of physical gold and silver right now are paying substantial premiums to the spot market,
right?
Often as much as 12%. Those premiums disappear with the New York Stock Exchange listed product. So certainly for many investors, but particularly for US taxpayers, there are extraordinary advantages to the Sprott physical trusts.
Yeah, in comparison to GLD or gold or both?
The big advantage, I think, over GLD, the big advantage to me is the tax advantage.
Okay.
One buys this to make money, and that presumes that one sells it someday for a capital gain. And to be taxed at the capital gains rate rather than the ordinary income tax rate is important. The other thing to note, it matters less to me, but it matters to some people who are even more paranoid than I, if that exists, is that all the assets of the Sprott Physical Trust are in physical precious metals. The ETFs shrink and swell in asset size every day, so they must buy and sell metal to accommodate the net asset value of those ETFs. which means that occasionally for some portion of their portfolio, they don't have physical precious metals, rather they have deposit or delivery receipts.
Hmm.
And if you had a circumstance, I'm not saying we will, but if you had a circumstance like 2008, where there was a liquidity crisis, GLD might find itself as, at least for part of their portfolio, the unsecured creditor to a counterparty. We would never find ourselves in that circumstance.
Yeah. And first of all, just so you know, you're talking to a guy that's wearing an end the Fed hat. So I I think I'm way out, probably past you on that tinfoil hat spectrum, Rick, that's for sure. So and if I understand it right, the custodian for GLD is HSBC, or the custodian for you guys is the Canadian Mint. So it
Okay.
kind of, you got to ask the question, would you prefer to have your counterparty with the Canadian Mint or with HSBC? Am I seeing that correctly?
Yeah, absolutely. And I mean, frankly, I've been a customer of HSBC's personally for 30 years, and I regard them as a good institution. But I don't want counterparty risk with my
Yeah.
gold. I have no interest. We joke, all of our metal is stored at the Royal Canadian Mint. They handle our redemptions, meaning if somebody turns in shares for metal, the Royal Canadian Mint handles the shipping and receiving and all of that.
Okay.
So we sort of joke that our security is provided by NATO. Uh, we are easily their largest private tenant, and they've delivered very good service to us.
That's great. How long have you been using them? How long has that product been around?
I think our first issuance occurred in 2009 or 2010.
Okay.
The provenance of the product is interesting, actually. It came about because Eric Sprott wanted to own several $100 million worth of physical precious metals. So Sprott product came about because there was a guy named Sprott who gave himself a lead order for, if my memory serves me correctly, $250 million. It was pretty obviously going to be an investor-friendly product because the guy who owned the company that managed the product was the guy who put up the lead order. And it was actually Eric himself, who is a former chartered accountant, who made sure that the tax status with regards to US investors was a capital gains basis rather than a collectibles basis.
That's really interesting. See, I'm glad I asked that question, but I want to move on. I've got a ton of questions here, Rick. The next thing, I know you always talk about gold compared to its main competitors, being the dollar and I believe the 10-year treasury. And you say kind of the catalyst for gold continuing to go up in this bull market we're in right now. And I think that's on everyone's mind. Is the bull market going to continue? Are we at the beginning? Are we at the end? What inning we're in? But going back to the 10-year, there's a lot of tailwind for gold if we've got negative real rates. So first of all, if you could explain that and how that's worked historically. And then when we get done with that, I've got kind of a curveball that I want to throw at you and see if it's kind of pick your brain a little bit.
Well, I look forward to that. Pick it with a small fork, but we'll get to it. With regards to unpacking the first part of the statement, for as long as I've been in the financial services business, which is to say in excess of 45 years, all financial assets in the world are priced off the world's benchmark security, which is the US 10-year treasury. It is, in fact, the security that all other securities are valued against. It's the largest, deepest, and most liquid savings and investment asset in the world. Gold moves for many reasons, most of which have to do with fear early on in the gold move. Later, it can move on momentum. But the most common fear that moves gold, and has for centuries, is fear of the degradation of the purchasing power of other savings instruments, particularly denominated in reserve currencies, like the US dollar. So when people are concerned about the stability of the purchasing power of their savings over time in the US 10-year treasury, gold does very well. So I suspect that there are several factors behind gold's move right now. The first is, as you say, negative interest rates. The idea that your risk premium associated with lending money to the US government is that they pay you 50 basis points in a currency that they acknowledge is depreciating by 160 basis points a year,
Right.
means that, as Jim Grant describes it, the chief competitor to gold offers up return-free risk. Not very attractive. Think about that concept, return-free risk. This
Right.
is the first promise that I can think of that my government has ever made me that's going to come true. They solemnly swear to give me back less money than I gave them at the beginning of the exercise. And I believe they'll keep this promise, and I'm not happy about it. The second factor, of course, is quantitative easing. The printing of, or they don't have to print anymore, the keystroke, the creation by keystroke of specious, spurious currency. If you did this, if you printed gammons or something like that, it would be called counterfeiting, and you would be a guest of the state in prison, in less nice accommodations than you have today. So the debasement of the currency obviously is very tough on the ongoing purchasing power of the currency. And the final is really related to that. It has to do with debt and deficits. We talked the last time that I was on your show about a year ago, and I was horrified that the on-balance sheet liabilities of the federal government exceeded 20 trillion.
Right.
Now they exceed 24 trillion. And in fact, in the month of July, the number went up by $850 billion. We incurred more debt in 1 month than we incurred in the first 200 years of this country's existence.
Yeah.
That makes people concerned too about the ongoing value of the purchasing power. But there's one more thing, George, that I think that your listeners need to examine. Many commentators, including, of course, Casey and Rogers and them, have commented on the deterioration of the purchasing power of the dollar as being responsible for gold strength. But there's another thing that people need to understand, which is that gold is underowned. Precious metals and precious metals related assets comprise less than 0.5% of all savings and investment assets in the United States. That's down from an estimated 8% in 1981.
Wow.
But importantly, it is way low than the 3-decade mean, which is between 1.5% or 2%. In order for gold to do well, in order for gold to hold its purchasing power, it doesn't need to regain its former panic-induced market share. It just needs to return to the 3-decade mean. If gold reverts to mean, which I believe it will, demand for precious metals and precious metals equities would go from less than 0.5% to 1.5% or 2%, which is to say that demand would triple or quadruple in the largest savings and investment market in the world. And I think that people need to bear that in mind too. The fact that gold is ludicrously underowned in a circumstance where the wind is in gold's sails.
Yeah, and expand on that a little bit, because I listened to a podcast you did the other day, and you were talking about how you kind of have an insider's view to what institutional money is doing right now. And you said going back to 2012, you guys were trying to pitch physical gold or your Sprott product to these institutional investors, and they weren't even giving you the time of day. And now all of a sudden, I think it's as of maybe a year ago or 12 months ago, they're calling you and life is good. And so is that kind of the first step that we're seeing towards that number you just talked about changing in favor of gold and the gold price?
I think it is. The narrative was in place for gold in 2011, 2012. But the extremes that we're seeing in terms of the policy response to the economy and COVID are so extraordinary now that conventional investors who have had no use for gold are acting on the thesis. The second thing is that in 2010, 2011, 2000 gold, it was very obvious that there was room to cut the interest rate on the US 10-year Treasury, which meant that although the yield return was paltry, the prospect of capital gains was 100%. If the 10-year Treasury was yielding 3.5, and it was pretty obvious that they were going to take it down to 1 or 0.5, it meant that there were capital gains to be had on the US 10-year Treasury that still made the US 10-year Treasury efficacious for very large investors.
Yeah. Even if at a negative real rate.
Right. How low can you go now? And what is your holding cost? It may be that there are capital gains left in the US 10-year Treasury. But the truth is, George, if you look at the 35-year history of the US 10-year Treasury, in 1981, which is to say the high point for gold and the low point for bonds, the US 10-year Treasury was yielding 15.5 or 15.6. Now it's yielding 50 basis points. We've had a 35-year bull market in the US 10-year Treasury. If you believe, like me, that the interest rate can't go much lower, then you believe the bond can't go much higher. Right. And I think it's very clear to these huge endowments and pension plans, whose primary asset has been US Treasury securities, that 35-year bull market is over for very good reasons. These aren't dumb guys who run these huge endowments. And the concept of return-free risk is not very attractive. Think of yourself running a large endowment, and your actuarial assumptions are that you have to earn 7.5% a year to preserve the purchasing power of your retirees in their retirement. And try and figure out how you do that with a 50 basis point yield in an instrument where the purchasing power is declining by 1.6% a year. You have to overcome a 1% negative bogey.
Right.
At the beginning of the exercise. It's very, very, very tough to do. And when these managers are looking at a market and they can tell that it's fundamentally changed, they become much more open to new ideas. Now, the narrative that we're talking to them about is the same narrative we've been talking to them about for 10 years. It's just that the arithmetic has caught up with the narrative.
Right. Does that hold true for a lot of these pension funds as well? I mean, my concern with the pension funds is they're not run by people who are that bright. So they might not even get the value of gold long term, but do you have any insider information there?
I like to believe that the pension funds that we're dealing with are run by fairly bright guys.
Okay, cool.
I'll tell you a funny anecdote about that, George, if we have time.
Sure.
There's a very, very large Asian parastatal pension fund that's been a client of ours for quite some time. And I remember back in 2016 talking to one of the managers of this pension fund and commenting on the extraordinary holdings they had of US 10-year treasuries. Mm-hmm. And I said to this pension fund manager, from an American point of view, from my point of view, this is very flattering. And it's also very useful. You guys send us all kinds of cool stuff, computers, steel, cars, chemicals, and we send you back pieces of paper with dreams painted on them. For trade to me. I said, just out of curiosity, given that the yield on the bond doesn't seem to me to offer enough risk premium given the depreciation of the currency.
Right.
You sort of regard the bond as a lie. And I'll never forget this. He looked at me and he smiled and he said, Rick, what you say is ultimately true, but yours is a deep and liquid lie, unlike the other lies that we're told on global financial markets. And I said, just out of curiosity, do you trust us? And he said, oh no, but we trust you more than we trust each other. And the point of all that is that the US has been, as Doug Casey characterizes it, the prettiest mare at the slaughterhouse for a long time. But being relatively attractive when you have to generate absolute yield, which these people do, means that their vacation in the bond, a 35-year vacation where they've had a tremendous run, is over, and they know it.
Yeah, that's such a cool story. When I was talking about pension funds, I'm talking about like CalPERS. And you just read all the stories about, how they're just a complete train wreck. But so going back to the negative real rates, I was trying to think this through the other day, and I'd love to get your take on it. What if we have a situation where the nominal rates on the 10-year go negative, but we get deflation somehow that goes even further negative? So you've got a nominal negative carry on the 10-year, but at the same time you've got a positive real rate. What do you think, just out of curiosity, that would do to gold?
I think it would hurt it. Although, if the market's response was total fear, gold does well in times of total fear. It is believed, and I think it's generally true, that mild deflation is not good for gold. Real deflation can be good for gold because gold is an asset that isn't simultaneously somebody else's liability.
Yeah.
Owning gold requires no trust. And in a real deflationary panic, the idea that you own an asset that isn't simultaneously somebody else's liability, which a bond is a very good thing. So I think it really depends on the extent to which the circumstance that you describe plays out.
Yeah, kind of the atmosphere. And I think there's a strong argument. I don't know if you listen to Mike Green. He's on Real Vision all the time. I'm actually going to interview him here in a couple weeks. But he's came out with a whole kind of research on if the 10-year goes negative. It's not like the German Bund. It's not like a JGB going negative. It's a whole different ballgame. And it could have some serious effects that would be very beneficial to gold. But moving on, I want to stay on the gold topic here. I don't know if you know my good buddy Hugh Hendry, and I've been hanging out with him in St. Bart's. He was a hedge fund manager for 17 years. He was a very popular guy, still is. But he and I were doing a live stream the other day, and one of the questions was, George, when would you sell your gold? And I said, I kind of thought about it for a moment. I go, I don't know that I would. Because to me, it's not about a capital gain with gold. It's just 10% of my portfolio that I just have as insurance. And I just don't know that there's a price where I would sell because that's not my rationale for owning it. And Hugh came in and he said, what are you talking about? That's the craziest thing I've ever heard. Of course, there's a price that you would sell gold. And I think he's looking at it from a standpoint of a hedge fund manager that has that monthly P&L. But I wanted to tell you that quick story to get your take on it. So maybe we could unpack why someone would own gold and maybe the pros and cons and how you're looking at it as far as playing a specific role and having a purpose within your portfolio, not just buying it because you think the price is going up, or maybe that's the thing to do. Maybe I'm crazy.
Well, I've done sort of all of the above. I mean, let's get it straight. I'm not your average listener. I'm old, fat, bald, rich. I probably don't need to own gold. But part of the essence of wealth for me is enhancing my sense of well-being, being able to sleep nights and stay calm. And gold does that for me. I'm a voracious student of history, and I have learned that when stuff gets lousy, gold does well. I hope that gold doesn't do well. In fact, I hope that when I am about to shed my mortal coil and I become reflective, that I think that all of the money that I stored in gold over time was a waste of money, which means that I will have had a very calm and very nice life. That is not correct, however. I have some gold in my portfolio that will never be sold. It just will not be sold. I began to purchase gold for a trading position in 2015, which is to say, most of my gold I bought so that I sleep nights and stay calm. But I also bought some gold because I thought it was just too cheap, and nobody cared about it. And that gold will be sold. My gold stocks may all be sold at some point in time. And that's why I like your question, what would cause you to sell? And I have told my clients very, very, very specifically that I have two quantitative targets that will cause me to revisit my premise and revisit my premise with a sell-side bias. The first would be positive real interest rates on the US 10-year Treasury of 250 or 300 basis points or above.
Okay.
That is to say yields in excess of the rate of inflation. By the way, I think that the CPI number is a bogus number. But I would even take 250 basis points above the CPI number, because other people believe it to be a real number, so it becomes a factoid. The second is market share. When gold begins to materially exceed the 2% market share when precious metals and precious metals related assets begin to materially exceed the 3-decade mean in market share of savings and investment assets, which is to say when they go from being way under-owned to being in line historically, I will revisit my premise. It doesn't mean I'll sell my gold stocks. If gold is at 3% of savings and investment assets in the United States, but the real interest rate is still strongly negative, if Congress is still counterfeiting, if the deficit and the debt continues the way it is. In other words, if that market share is justified, while I will review my position, I'll probably stay with it. But I think it's important in a narrative-driven investment thesis like gold that you establish quantitative goalposts to force yourself to revisit your premise from time to time. And those are the two for me: real yield on the US interest rate and gold regaining or at least recovering, reverting to mean in terms of market share.
How do you juxtapose that? Because I mean, I'm a gold bull for sure, but one thing I get worried about, I see the Fed's balance sheet, I see the 4+ trillion in deficits we'll have just this year, which is, according to my calculation, I had a chart the other day that from 1776 to 2000, we had about 4 trillion, right around 5 trillion in debt. And just this year will eclipse that for the 1 year. I mean, it's shocking numbers. So that's a lot of tailwind for gold. But I also get a little concerned with every time I listen to a Real Vision video or maybe listen to Macro Voices or every person I have on my show, every single person is bullish on gold. I don't, maybe there's a couple that might not be as bullish short term, but even long term, they're all bullish. And whenever I see that, I get concerned. So is my concern justified, maybe short term, or what do you think?
Well, I think statistics matter, and the fact that precious metals and precious metals related assets comprise less than 0.5% of total savings and investment assets in the United States tells me the gold's under-owned. I would also say, George, at risk of being thrown off your show, that in effect, you are a Pentecostal preacher asking your own choir if they believe in God.
Yeah. Yeah, it's definitely an echo chamber I've got here for sure.
Around in a fairly small neighborhood. I can tell you this: I speak to lots of financial advisors around the United States. People who tell other people what to do with their money. And I'll give these guys the gold thesis. They've been in a 30-year equities bull market and a 35-year bond bull market.
Yeah.
And most of these advisors can't spell gold.
You're kidding. Wow.
I mean, they can't spell gold. I mean, I go through this and, these guys are really good salesmen usually, right?
Yeah.
And so I come with my pitch. It's a simple pitch. It's easy to understand. It's easy to repeat. They say, that's a hell of an idea. I never thought of it.
Are you kidding me?
Oh, and I'm talking about, in the financial planning firms and the big wirehouses, in the regionals, I talk to these FAs around the country, and I give them the same sort of thing that I gave you: return-free risk, all that kind of stuff.
And they don't see what's going on with the Fed and the base money just exploding, and now even M2's exploding.
Well, they use that as a reason to buy stocks. They say, listen, the yield on debt, the yield on savings products is so low that people are being forced into equities markets, and equities are going up because they're going up. And that in the near term, I think it's probably true. But what's of interest to me is that of the FAs that I get introduced to, particularly in broadcasts that are continuing education broadcasts, which is to say the ones that guys have to take.
Yeah.
It's odd to be in a circumstance where financial professionals have been, or rather where gold has been so unpopular for so many years that financial professionals don't even think of it as an asset class.
Yeah, well, that's great news. I mean, I'm glad to hear that. That's fantastic.
Let's move away from the narrative and the anecdote and go back to the statistics.
Yeah.
Less than 0.5% of savings and investment assets in the United States are precious metals and precious metals related investments. That says it all.
Yeah. So on that note, going back to kind of the normies in the mainstream, let's talk about Buffett. No one is more mainstream than Buffett. So he goes from calling gold a pet rock to now buying, what is it, 560 million worth of Barrick. And that's what we know about so far. My guess is he can't take a position all in one shot. So he could be buying more in the last few weeks. But what's your take on that?
My take is that he still believes it's his pet rock.
Okay.
He famously said the only thing he likes about the investment is if you smile at it, it's shiny enough and it smiles back at you, which I always thought was a great description. But what it says about gold is much more interesting.
Yeah.
First of all, he doesn't like the asset class. And I suspect that he didn't make the investment. At $500 million, while his investment was important to Barrick, it isn't important to him. It doesn't represent even a rounding error in Berkshire Hathaway. Similar to his silver investment in 1997, it mattered greatly to the silver bugs, and Buffett described it as an amusement. But what I think is important about it is that it proves that gold stocks are cheap by objective measurements. Buffett buys companies because the method he uses is fairly simple. He looks at the enterprise value, which is to say market capitalization minus debt plus cash, the price that one would pay if one bought the whole company. And he puts that against the expected net present value of future cash flows from identifiable operations. Now, he can do whatever he wants to with his money. There are lots of companies that he knows very well: American Express, Coca-Cola, Procter & Gamble, Johnson & Johnson, companies where he's already done the fundamental research. The easiest thing for him to do is spend $500 billion to buy more shares of a company that he knows and trusts and loves already. But rather than that, he's buying Barrick, which means from his point of view, Barrick is cheaper.
Right.
The free cash flow yield on Barrick is cheaper. It's important too, because he doesn't like the product. He burdens the Barrick decision every way he can. He hates capital intensive businesses. Mining is capital intensive. He hates cyclical businesses. Mining is cyclical. And he doesn't like gold, despite the fact that three of his most important attributes in this circumstance mitigate against the decision. The net present value of the future cash flows in Barrick relative to its enterprise value are so high that he's compelled to buy it.
Yeah.
And I think that says an awful lot about the relative valuation of gold mining shares relative to other types of equity investments available to people.
Yeah. And long term. I mean, it's not like he's someone that is just trading all the time and scalping and even swing trading. I mean, he's buying stuff to hold it just for a long, long time. I think that says a lot as well. Can you talk about the expense side of the miners right now, with the gold miners and the silver? I know silver is kind of a byproduct, so let's focus on the gold miners. But we're just looking at the price, the normal people like myself, but there's a whole other component of the P&L, which is the expense side, which is extremely beneficial right now as well. It's an additional tailwind. Can you go over that? Yeah,
it's huge. You have an end the Fed cap on, but the Fed is doing a wonderful thing for the gold business both ways. First, by debasing the currency, they're putting headwind into the commodity price. In other words, they increase the price of the stuff we produce. But by keeping the cost of capital artificially low, in a capital intensive business, they're subsidizing our cost of capital.
Right.
So they're actually subsidizing us two ways. They don't think about it, or if they did, they wouldn't like it, but it doesn't much matter. By keeping the cost of capital artificially low in a capital intensive business, you lower the most important input cost in mining, which is to say capital. At the same time, a soft economy worldwide lowers all of our other input costs, particularly if you produce gold outside the United States, because as weak as we believe our currency may be, we are, as Doug Casey says, the prettiest mare at the slaughterhouse. And other currencies, the Australian dollar and the Canadian dollar, as an example, are declining in price faster. And if you produce gold in those countries, your input costs are denominated in their local currency, which is to say, in real terms, the input costs are going lower.
Right.
The third variable, of course, is energy prices. The collapse in energy prices over the last 2.5 years has been enormously beneficial to the gold mining industry. The second, third, or fourth most important input in gold mining is, of course, energy. It's a very, very, very energy intensive business. And the total collapse in energy prices has been an enormous subsidy for the gold business. So the gold business is in this wonderful sweet spot, a three-way sweet spot. The first is ironic. A 10-year bear market in the mining business has meant that the management teams are unusually rational. They're disinclined to make the same mistakes that they made 10 years ago because the people who made those mistakes mostly got fired.
Yeah.
So they are rational operators with clean balance sheets, with their input costs declining and the price of the product that they produce increasing.
Yeah.
Buffett himself once said, buy a business that's good enough that it could be run by a moron, because sooner or later it will be. And a circumstance, from my point of view, in the next couple of years, where I see the input costs continuing to be flat or going down, while I see the price of the product that I produce increasing, means that almost no matter what I do, my margin increases.
Right.
And I like business. I mean, listen, there's no certainties in life, but this seems to me like the best range of probabilities that we've seen in a long time.
Yeah, that's great insight. Also, I spoke with Marin the other day, and he was talking about swap lines. I wanted to get your feedback on if a mining company has assets in these jurisdictions that might not have swap lines. Do you think that's a big deal? Do you think there's something to that? Should an investor be more focused now if they're buying a gold miner as to where their assets actually are from a jurisdiction standpoint, or do you think that's kind of a moot issue?
I need to begin by saying I have a lot of respect for Marin. He's sort of an acolyte of mine. I'm very fond of him as a thinker and as a human being. And I think it's probably the 15th most important thing that one would consider when buying. It is true that companies that have access to the US Fed, that is to say, countries that have the ability to refinance through swaps their US dollar denominated debt, will have more stable capital markets.
Yeah.
And I think that's something to consider. But I think management quality, asset quality, company balance sheet, individual country fiscal policy, I think all of those are more important, and in fact, much more. Marin is to be congratulated for thinking it up, because it's a wonderful piece of copy that increases his own status in the gold community. I think it was a stroke of genius. And I think it's something to consider, but I don't think it is in the first tier of my own considerations.
Yeah, that makes sense. Okay, so we've talked about gold. I want to move on. Let's talk about uranium. And I heard you on a podcast the other day. You say short term, the kind of layup or the low-lying fruit is precious metals. It's gold and silver. But long term, and I think you define that as maybe 4 years out, we could see some big upside in uranium. I think you talked about the cost, the production cost there, and what the price is, and just a lot of tailwind. And we know that the cure for low prices are low prices, and it seems to be really playing out right now with uranium. But people have been saying that for quite a few years. So what do you think?
Myself included.
Yeah.
The last uranium bull market was probably the single most pleasant financial event of my life. But I need to remember that I wasn't merely early for that. I was 4.5 or 5 years early.
Okay.
If, depending on how you price your capital, at a 7% cost of capital as example, 6 years early isn't early, it's wrong. Now, the truth is that the bull market that occurred in uranium paid me so much rent in such a short period of time that there was no cost of capital hurdle it couldn't overcome. And I have been early too in this uranium cycle. It had been my belief that the cause of this uranium downturn, which is to say the shutdown of the Fukushima nuclear plant in Japan and the rest of the Japanese nuclear fleet, would have turned around sooner than it would, and that the Japanese inventories, which are regarded now as held for sale, would become nuclear fuel inventories and off the market. And that hasn't happened. So your listeners need to understand that the circumstance that I'm describing is something that could easily be 18 to 36 months out.
Right.
But from a contrarian's point of view, you have to love uranium, particularly because everybody hates it. In the comments section that will accompany this video, should you put it on YouTube, many of your listeners will say Rick Rule is a despicable human being.
I don't think so, Rick.
They will say he is speculating in Chernobyl, 3 Mile Island, Hiroshima, Nagasaki, and Fukushima.
Okay.
The half-life of plutonium is 1 billion years or something like that. They will do it, which from a contrarian's point of view is as good as it gets. It means that people aren't merely bored by it, they hate it. And while I probably like to be loved too, I like my portfolio to be hated as opposed to loved. So I get that with uranium. More importantly, however, irrespective of how we feel about the narrative, uranium is important for how we live. Even in countries that believe themselves to be rich countries, like the United States, uranium provides 15% of the overall power mix and almost 20% of the baseload mix, which is to say that if uranium production would cease because it was uneconomic to produce it, the lights would go out. So the question that your listeners need to ask themselves as speculators, not as priests, but as speculators, is 6 years from now or 7 years from now, is it more likely, sorry about that, is it more likely that the uranium price goes up or the lights go out? Because those are the only two choices. I believe that the uranium price goes up. Let's look at the numbers. The International Energy Agency suggests, hold on one second. The International Energy Agency suggests that the fully loaded cost to produce a pound of uranium, not just the mining cost, but the finding cost, prior year write-downs, cost of capital, stuff like that, is between 55 and 60 US dollars a pound. So the industry worldwide makes the stuff for, let's call it 50 to be conservative. They make the stuff for 50 bucks a pound and they sell it for 30 bucks a pound. Being miners, of course, they try and make it up on volume. They lose 20 bucks a pound, something like 90 million times a year. And it's getting boring. It's getting boring enough that they're shutting down production, not making sustaining capital investments. But if you don't make sustaining capital investments, your ability to produce it goes away. And I think that's what's going to happen. I think that the price of uranium has to increase to a price that is sufficient for the industry to earn a competitive cost of capital. What's really important about uranium, though, what makes it more, pardon the pun, explosive than gold, is really two factors. One, when you balance supply and demand by reducing supply and the ability to supply, when the market tightens and the price begins to move up, the industry can't increase production rapidly to meet the pricing signals because it takes a long time to permit and build and reopen a uranium mine. So from the point of time in which demand exceeds supply, it could take 6 or 7 years to impact supply. The more important thing is that the economic utility of uranium relative to its cost is huge. Right. It's estimated that in most nuclear power plants, 3% of the cost of generating electricity is the fuel cost. The legal bills on an annual basis are always higher than the uranium price. So if the uranium price doubles, it doesn't change the cost of producing electricity. Demand for uranium is inelastic relative to price. In my experience, over time, when the price of something has to go up, and it can go up, it will go up. This is what I like to refer to as a when question. There are two kinds of questions in the world. One where the answer begins with when, meaning it's going to happen. You just don't know when. The other is an if question, where the answer begins with if. If this happens, and this happens, then this happens. I've learned after 67 years on Earth that when questions are better than if questions.
Yeah. How do you see the election affecting the demand side of the equation, if at all?
I don't.
Yeah.
You know, people make all kinds of noise about all kinds of stuff, and Biden will make all kinds of noise, and AOC and all these people and Trump. I mean, they'll all make noise.
Yeah.
And they'll say whatever they think it'll help them to get elected. But when the smoke clears, when people, even AOC, walks into a room and she hits the switch, she wants the lights to come on. And more importantly, her constituency wants to keep the lights on. And if she presides over a circumstance, pardon me, where her electoral district blacks out, she won't have a forum to make all these outrageous statements anymore.
Yeah.
Over time, irrespective of her rhetoric, she would like a circumstance. I mean, she couldn't be on TV anymore because there wouldn't be any electricity for the TV. What would she do?
Yeah, exactly. She couldn't make those videos and post them to Twitter calling, what was it, Milton Keynes? She could, did you see that one?
I mean, I must admit, there's a lot about her I like. Her impertinence. And I love a politician that dances. I mean, I couldn't imagine Trump dancing. What I mean is I like a politician that you like to watch dance. It's just her policies that I don't like. The rest of her I'm fond of.
Yeah. Yeah. Okay, so if we didn't piss off everyone right there with uranium, let's make sure we get the job done right now, Rick. And I want to get your opinion on coal.
You know, I'm prepared to believe that the share of thermal coal in power generation, that is electrical coal, is beginning to be in terminal decline. Although the largest coal consuming year we have ever had in recorded history was 2019. Coal demand is increasing rather than decreasing. But I'm of the opinion that low-grade thermal coal is in terminal decline. But I don't believe that steel making is in terminal decline.
Right.
And therefore, I believe that metallurgical coal will continue to be in good demand. So I think that your listeners need to understand that there isn't a coal market per se. There are 55 or 60 markets. And high quality, low sulfur, low ash, metallurgical coal, I think will continue to be in very, very, very strong demand. Brown coal, lignite, dirty coal, ironically, the kind of coal that they burn in Germany to keep the lights on now that they've shut down nuclear power. I love irony. I think is in fact in decline. It doesn't mean that if you are buying a business that will be out of business 12 years from now, but you're buying it so cheaply that the net present value of the cash flow between 12 years from now and now, it doesn't mean that isn't a good speculation. Those could be very good speculations. But as a sector, I'm certainly more attracted to nuclear than I am in particular the thermal coal space, although the thermal coal space is pathologically cheap.
Yeah. I mean, that's why I've looked at, I actually bought some back in March when it just got super cheap, and the dividend on this one that I was buying was up 19%. I'm like, okay, let's do it. And I bought it. And then of course, everyone tells me, you know, not everyone, but people, they get mad at you because of the environmental impacts and whatnot. But I say, listen, it's going into steel and pretty much everything that you just said. And it's dirt cheap right now. It's definitely hated. That's for sure. So it checks that box in Rick Rule's portfolio for sure. So we pissed off all the greenies right there, Rick. Let's make them a little happier, and let's talk about copper, because if I'm not mistaken, copper can be used for Teslas and electric vehicles like Nikola's, which I'm sure you're a big fan of the valuation of that company recently. But what do you think about copper?
I like copper long term. I have been suspecting all this year that the copper price was going to go lower, and mercifully, I've been wrong. It's gone higher. I own copper mining companies, despite the fact I think the copper price is going lower. Because in prior recoveries, I've made so much money in the copper mining business. a good copper mine is a real gift from God. They make lots and lots and lots of money. I still believe that the price of most industrial materials will stay flat or go lower for the next 2 or 3 or 4 years. I think that we need to unwind the economic excesses globally that we enjoyed from the 2009 to 2019 economic recovery. I think that recovery was partly false. I don't think it was a recovery that was engendered by increases in productivity or increases in world trade or increases in individual wealth. I think that recovery was engendered by artificially low interest rates and by quantitative easing, though I think it was partially false.
Right.
And I think we need to unwind it. I think we also need to unwind the negative impacts of COVID on the global economy and global trade. And we need to discount increasing economic nationalism around the world and restrictive policies which make everyone poorer. So my economic outlook personally, although I'm not an economist, is to be charitable timid. And I'm personally thinking that we will see flat or lower prices for all industrial materials, copper included. But I believe that the price of most industrial materials is already below the incentive price for sustaining capital or new capital investments, which is to say, in the case of all of the industrial materials, copper and oil and gas included, that a tepid price response in the next 3 or 4 years will ultimately set off a commodities and a commodity stock rally 4 years from now or 5 years from now that will be reminiscent of the rally that I enjoyed in the 2000 to 2005 timeframe, which is to say, in very rude Wall Street parlance, a rip your face off rally.
Right.
Not one that I expect to occur soon, and I expect commodities to be roundly hated by the time they take off. But I really think towards the end of my career, I'm at age 67, that I'm going to be the beneficiary of 2 bull markets, a precious metals bull market, which I think is already underway, and then an industrial materials bull market. It's difficult for me to imagine a better way to go out.
Yeah. How do you fit agriculture in there?
One of the few things I'm buying right now is very high quality farmland in the US upper Midwest.
Huh.
Soft commodity prices have fallen by 50%, which is to say that farm gate rents have fallen fairly substantially. The price of the best agricultural land in the world, which is in the US upper Midwest, in my opinion, have fallen. And there's lots of demographic trends that I think are important. Importantly, in the US upper Midwest, in addition to having access to the best market in the world, the United States, you have very high quality soils, you have lots of water, and importantly, you have a river system which lowers the price of your inputs because you can move it by water rather than by highway, and lowers the price of your exports. At the same time, you have a whole generation of ancient farmers, which is to say my age, leaving the business and their kids not wanting to go into farming. Yeah. So the 300 acre, 400 acre operator is going away, and the 5,000 and 6,000 acre operator is coming back, which means that you can buy a very high quality asset class at distressed prices and lease it out on a triple net basis, the same way that you would of an apartment building in 1990. For me, it's an unusually attractive economic circumstance. I have a portfolio, a passive portfolio of high quality developed real estate, which I'm in the process of selling. I don't see the interest rates going any lower, and so I don't see the tailwind that I enjoyed in developed real estate for the last 30 years continuing. And I'm basically taking the proceeds and putting it into triple net leased, very high quality farmland in the US upper Midwest.
That's really interesting. I'm sure glad we touched on that. That's got the wheels turning. I'm going to definitely think about that one over the weekend for sure. So lastly, and I want to be cognizant of your time, I want to ask you a personal question. And I know that it looks like you're building a house right now. We talked, that's in the state of Washington, but I think, and correct me if I'm wrong, that you spend a lot of time in California. And I have just, I don't spend much time in the States, but I've been reading about what they're proposing in California. And every single time I read another headline, I just shake my head and say, what on earth is going on there? I mean, this most recent thing with Uber and Lyft, everyone knows about that. But then the the wealth tax that they're proposing of 0.4%. And I realize it's on people that have assets of over 30 million. But if you study history, you know, especially like the income tax, yeah, it starts at 6%, and in 4 years, it's 70%. And those taxes have a way of the rate creeping up and the floor going down, 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 down to pretty soon it affects not only the rich, but the middle class as well. And I'd also like to add for the viewers that might not have heard about this, it's a retroactive tax going back 10 years. So if you live in California in 2010 and now you live in China, for heaven's sakes, they might still come after you. So what, and I know you as a quote unquote, I guess, California insider, you're right there in the belly of the beast. So what's your opinion on this?
Well, I need to say that I, from a legal perspective, no longer have any nexus to California.
Oh, wow, congratulations.
I sold my home, I sold all my actively managed real estate. The board of directors of Sprott has asked me to take on other roles within Sprott rather than running the California operation. So despite the fact that I'm a Californian by culture, which I am, I was born and raised in the state and I adore the place, I no longer have ties to the state. Now, when I say I adore the place, I adore Venice Beach, girls in thong bikinis, Beach Boulevard, smoking a joint, knowing that in a traffic jam, the cops can't get them. I enjoy a culture that's creative enough that 6 or 7 kids commandeer a garage and out pops Google or Apple.
Yeah.
I mean, unfortunately, those same or a different 6 or 7 kids commandeered a garage in Berkeley 40 years ago and out popped popularized LSD, which it would seem that all the voters in California have been consuming.
In large amounts.
Well, we're wonderful people individually, and as individuals, we can generate so much wealth that hitherto we've been able to amortize our collective stupidity. I think our collective stupidity now is overwhelming our individual creativity and initiative. We're doing truly bizarre things in the state of California, and the bizarre nature of the state has come to antagonize rather than amuse me in my declining years. Yeah. The state of California has the most steeply progressive, which is to say the most unfair tax rate in the United States. When the former Speaker of the Legislative Assembly in California, Willie Brown, had the temerity in 2009 to say that the rich had caused the financial crisis and the rich had to pay their fair share, I immediately emailed his lordship and said, Mr. Brown, I'm delighted that a populist politician finally had the courage to say that the rich must pay their fair share. 1% of California taxpayers pay 42% of the tax. When might I expect my rebate? My response from his honor was, citizen input is an important part of a functioning democracy, and we value your participation in the process, unquote, which is to say, he wasn't interested in giving me a rebate. That number now has grown to 46%. And the big thinkers, well, first of all, you need to know that California feeds in Silicon Valley. Yeah. In other words, the whole state runs on technology. And if you have a circumstance where there is a decline in technology like we had in 2000, the state goes upside down, and it goes upside down very, very, very quickly.
Yeah, see, that's a great point. I made that point on Twitter, and I'm glad you said that, because I wanted to make sure I was thinking it through. I compared it to Venezuela, and of course it's not that extreme, but you look at Venezuela, the one-trick pony, and California might be the same there in the sense that it's all riding on that one thing.
Yeah, on Silicon Valley. And so what they've decided to do is, first of all, increase the California income tax rate from extortion, which is to say 13.4 or something like that, to ludicrous, yeah. Which is 16.5. And then they've decided to put a wealth tax in place, and they have decided to impose these taxes extraterritorially, which is to say, if you leave the state, they're going to chase you.
Mm.
Now, the state of California has tried extraterritorial taxes before and been beaten in the Supreme Court. Believe me, if they propose to follow me to the state of Washington, they will learn, first of all, the difference between invoice and remit, which are two different words. And the second is that I and others will see them in court.
Yeah.
As simple as that. Now, my suspicion is that what the, quote, progressive members of the California legislature are doing, by the way, it's interesting how the left steals the word progressive. It should be
and liberal.
Or regressive. Well, I regard myself as a liberal, as a John Locke classical liberal, but that's a different discussion. What I think these people are doing is that they're establishing a very strong base to retreat from, which means that they're proposing something preposterous so that they can replace it with something obnoxious and have it look like a compromise. But that being said, irrespective of what happens with regards to these two measures, which I think will be defeated, the writing is on the wall. The fiscal structure of the state of California is unsustainable. California runs on rich people, and they're driving the rich people away. The other thing is that even a business as great as technology, and even a region as spectacular for the world as Silicon Valley, occasionally has setbacks. And the state of California has put themselves in a position where they can't afford the setback.
Right.
They simply can't afford the setback. When the setback occurs, and it's going to occur, there are tens of millions of people in the state of California who have come to be dependent on the largesse of the technology billionaires without thinking too much about why. And they're going to be angry, really angry. And I think it's going to be a very interesting circumstance. And I look forward to watching it from a distance on a broad screen TV.
Yeah, maybe more social unrest. You hate to say it, but it's just with the decisions they're making, it seems to be an inevitable path. But all right, so, Rick, I could keep going forever, but I know we've gone over an hour here. So one thing that I'm having the editors do throughout this is I'm going to have them throw up this promo bit to get people to the end, because we talked about this before we recorded, but this is a really cool opportunity you're giving people. And I don't want to steal your thunder, but I think you're allowing people to actually email you directly to get your thoughts on their portfolio. Do you want to explain that further?
Yeah, I do, George. I've really enjoyed my prior interaction with your listeners. They're a unique group, and I don't mean that in a condescending sense. I like it. And so to encourage this interaction, and because mentoring is probably the last remaining joy for a 67-year-old, I'd like to encourage your audience to interact with me. And that encouragement comes in the following fashion. Any of your listeners can go to a web link, which is sprotusa.com/rankings.
Okay.
Sprott, SPROTT, USA/rankings. You will find a web form. And if on that web form, you will put in place all of your natural resource investments, which is to say natural resource equities, names and symbols, please, and any questions that you might have below, I will rank your resource companies 1 to 10, 1 being best, 10 being worst. I will comment on individual issues where I think my comments are of some value. And in addition, I will send out 2 charts. One, the Barron's Gold Mining Index chart going back 50 years, the broadest based and longest gold mining equities index chart available, which is a wonderful visualization tool to see where this bull market is in the context of prior bull markets and how far it can go. And also a 100-year commodity chart, which will show you how cheap commodities are relative to other asset classes based on their relative prices over the last 100 years. So I'm happy to rank the portfolios and send these 2 visual aids. By the way, I'm not a technical analyst, so I'm not going to do, double tops, rounded bottoms, all those sort of female description markets. I'm only referring to these charts as visual tools uh, relative to the performance and price expectations of markets in their historical context.
Yeah.
And I look forward to the interaction that I've had in prior times with your audience.
Yeah, well, I sure appreciate the offer, Rick. I'm got a feeling you're going to get a lot of people that take you up on that. So for any of my viewers who want to find out more about what you do, other than having them email you directly with their portfolio, where can they go? What website? And maybe where can they go to buy PHYS if they're interested in doing that?
Well, PHYS, they can buy through any broker they want to.
Okay.
If their broker isn't familiar with it, they got to get a better broker. And I, of course, would suggest Sprott. That website is www.sprottglobal.com. www.sprottglobal.com.
All right, Rick, I appreciate your time and I cannot wait to do this again.
Listen, I really appreciate the opportunity. I also need to tell your people that I'm anticipating getting inundated with ranking requests. So be patient in terms of my response because I'm the responder.
Yeah. Okay, Rick. And just so you know, we'll put a link, that link that Rick just mentioned right there, we'll put it in the description and I'll have the editors put that up on the screen so nobody misses it.
That's wonderful. This was fun. Let's do this more frequently.
I would love to. All right, Rick. Have a good one and good luck with that house, buddy.
Thank you very much, sir.